2025 has been a rough year for Tesla. The stock price is down 30% from an all-time high in January. Vehicle deliveries are down 13% compared to the same period last year, which was already Tesla's worst quarter in years. The Cybertruck is falling apart both figuratively and literally, and most disturbing of all, Tesla vehicles, dealerships, service centers, and charging stations are literally being burned to the ground, not just in America, but all around the world. As a Tesla owner, you can't even leave your car parked on the street without a legitimate concern that someone will vandalize it. And throughout all of this, where was Elon Musk? In Washington, D.C., playing politics. How's that gone? Musk seemingly believed that his legendary Silicon Valley influence would translate to the political stage of the American Midwest. It didn't. Elon's multi-million-dollar campaign to elect a Republican judge in Wisconsin failed to secure victory in a state where Donald Trump had swung the vote in the Republicans' favor just 6 months ago. And now, Elon's decided to pack up his cheese hat and leave Washington. He's going back to work, returning to an operation in shambles. But how will he be received? Will Musk ride in like Gandalf at first light on the 5th day at Helm's Deep? Or is this Julius Caesar walking into the Capitol on the Ides of March? Is Elon Musk still Tesla's greatest asset? Or has he become the company's biggest risk? For years, the answer seemed obvious. Tesla was Musk and Musk was Tesla. His vision, his ambition, his sheer force of will built the company into a global powerhouse. But Tesla isn't just Elon Musk. Unlike SpaceX, The Boring Company, or Neuralink, Tesla is a publicly traded company. Musk doesn't own it outright. He answers to shareholders, a board of directors, and the market itself. If those forces decide Tesla is better off without him, they can remove him. It sounds impossible, but history suggests it's not. A century ago, Thomas Edison found himself in a strikingly similar position. He was America's greatest inventor. He built an empire on electricity, revolutionized communication, and founded what would become General Electric. And then, like Musk, he got distracted. Edison became convinced that government inefficiency was America's biggest problem. He pushed for the creation of the Naval Consulting Board, a civilian-led effort to modernize the U.S. military. The dream never quite materialized. The military brass didn't want civilian interference. Edison's big ideas, giant underwater sound detection walls, and electric-powered ships, they never went anywhere. And while he was busy fixing the government, General Electric was evolving without him. The company moved on, professionalized its leadership, and quietly pushed him aside. And it thrived. Fast forward to 2025, and Musk is walking the same path. His latest project, the Department of Government Efficiency, or DOGE, is his own naval consulting board, an ambitious attempt to bring Tesla-style disruption to Washington's bureaucracy. And just like Edison, he's finding out that government doesn't move like a startup. Congress is skeptical. Regulators are resisting. Even Elon's closest allies are starting to question whether he understands how Washington actually works. Meanwhile, Tesla is spiraling. Sales are down. The Cybertruck rollout is a mess. Chinese competitors like BYD are closing in fast. People all around the world are literally burning Teslas in the streets. And while Musk is busy reforming Washington, Tesla's stock is getting hammered. Investors are watching, so is the board, and for the first time people are asking, does Tesla need Musk more than Musk needs Tesla? When founder-led companies hit a crisis point, boards and investors make tough calls. It happened at Uber. It happened at WeWork. It even happened at Apple. And if Tesla's stock keeps falling, it could happen there too. But to understand how, we need to be clear about who actually has the power to remove him and who doesn't. Musk first secured the role of the chairman of the board of Tesla after investing $6 million of his own money and leading Tesla's first major funding round in 2004. Musk wielded immense control as chairman until one impulsive tweet changed everything. In August 2018, Musk famously declared on Twitter that he was considering taking Tesla private at $420 per share, claiming he had the necessary funding secured. This triggered an SEC investigation, leading to a $40 million settlement and a requirement that Musk step down as chairman for at least 3 years. In response, Tesla added new independent directors, but many questioned how independent they truly were. Since Musk's forced departure as chairman in 2018, Australian business executive Robin Denholm has led Tesla's board. A former Toyota Australia executive with a background in finance and technology, Denholm was handpicked for the role, initially declining, but later accepting at Musk's personal request. Despite being positioned as an independent chair, her financial ties to Tesla are substantial. She has earned approximately $682 million in cash and stock since 2014, selling more than $500 million in Tesla shares in that time. Tesla's board is legally required to act in the best interest of shareholders, but critics argue that it functions more like a circle of Musk loyalists. Last year, a Delaware court ruling struck down Musk's $56 billion compensation package, citing the close relationships between Tesla's board of directors and Musk's influence over them. To explore how independent Tesla's board of directors really is, it may help to examine its members one by one. So, who is on the board? As chair, Robin Denholm sits at the head of the table. Her job, at least in theory, is to ensure Tesla's board provides independent oversight of Musk and his decisions. Then there's Ira Ehrenpreis. He's been with the company for years and chairs 2 of its most important committees, compensation and nominating and governance. These committees are supposed to ensure executive pay is fair and that the board itself operates with integrity. Ehrenpreis has been described as a close Musk ally, and he was instrumental in approving Musk's legendary $56 billion pay package. The one a Delaware judge ruled was excessive. James Murdoch brings another layer of intrigue. The son of media mogul Rupert Murdoch, James has been on Tesla's board since 2017, and his personal relationship with Musk goes way back. Over the years, the two have vacationed together and spent plenty of time socializing outside of work. That kind of friendship raises questions about whether Murdoch can hold Musk accountable if and when that time comes. Then there's Kimball Musk, Elon's brother, which begs the question, how can a sibling provide true oversight? While Kimball has his own business ventures, mainly in the restaurant industry, he has always been deeply intertwined with Musk's companies. He's also cashed out significant amounts of Tesla stock over the years, including a recent sale that netted him tens of millions. Next is Brad Buss. Brad has long been part of Musk's business world. Before joining Tesla's board, he was the chief financial officer of SolarCity, the solar panel company founded by Musk's cousins and later acquired by Tesla. Kathleen Wilson-Thompson brings a different perspective. She joined Tesla's board in 2018 following the SEC's mandate to add more independent directors. Her background is in corporate governance and human resources, and she previously worked as an executive at Walgreens and Kellogg's. Unlike some of the other members of the board, she doesn't have the same deep financial or personal ties to Musk. Hiromichi Mizuno is one of the newer faces on Tesla's board, having joined in 2020. He previously managed Japan's government pension investment fund, one of the largest pools of money in the world. His strong views against short selling closely align Mizuno with Musk's own public stance on the issue. That ideological similarity suggests he is more of a philosophical ally than a true independent check on Musk's power. Linda Johnson Rice joined Tesla's board in 2017, at a time when the company was under pressure to increase diversity in its leadership. She brought experience from the publishing industry, having run the Johnson Publishing Company, which produced Ebony and Jet magazines. Her expertise in media and branding differs from the tech-heavy background of most other board members, but her influence over Tesla's governance remains unclear. Vaibhav Taneja, Tesla's chief financial officer, is also on the board. His role is somewhat unique. Most companies don't have their CFO sitting on the board, as it creates a potential conflict of interest. Taneja oversees Tesla's financials while also serving as a director, meaning he is essentially in a position to oversee himself. Joe Gebbia, co-founder of Airbnb, is another more recent addition to the board. Unlike most of Tesla's other board members, Gebbia does not have deep financial ties to Musk's businesses, which may make him more of a neutral figure. However, as a fellow entrepreneur, he shares Musk's Silicon Valley ethos, which could influence how he approaches decision-making within the boardroom. Tesla's board is a mix of Musk's friends, business allies, and a handful of people who were brought in after the government put their foot down. But when push comes to shove, the board has historically demonstrated that it operates more as a Musk support system than as a truly independent governing body. Together, the board is responsible for day-to-day governance decisions. They oversee the company's strategic direction, approve major financial moves, and critically, they have the power to remove the CEO. If the board decides Musk's leadership is too volatile, they can vote to fire him as CEO and replace him with someone else. He would still own Tesla stock, he would still be a public figure, but he would no longer be in charge of daily operations. That is exactly what happened to Travis Kalanick at Uber in 2017. His board, under pressure from major investors, forced him out, arguing that his leadership was damaging the company's reputation and financial stability. Kalanick was the face of Uber, brilliant, aggressive, relentless. He had built the company into a global transportation powerhouse, but his leadership was becoming a liability. Scandals piled up, employees revolted, customers turned on the brand, and Uber's investors had to ask a brutal question. Could the company survive without the man who built it? And the answer was yes. Uber's board, backed by major investors, forced Kalanick to step down. At first, the market panicked, the stock took a hit, but then Uber stabilized. It went public at an $82 billion valuation. It regained credibility. It moved forward without him. The lesson, even when a founder seems irreplaceable, sometimes they aren't. But what happens if Tesla's board of directors continue to stand with Musk no matter what? This is where the shareholders come in. Tesla's shareholders, the people and institutions that own the company's stock, don't have the power to fire Musk directly. They can't remove him as CEO or force him to step down. But what they can do is vote to restructure the board itself, pushing for more independent directors who might be willing to take action. If enough large shareholders like BlackRock, Vanguard, or even retail investors demand change, the board will be under immense pressure to act. The opposite lesson comes from WeWork. When investors lost confidence in their founder's leadership, they pressured the board to act and he was removed, but not before the company had already self-destructed. Adam Neumann had built WeWork into a $47 billion real estate empire. He was a visionary, a showman, a charismatic force that investors believed in until they didn't. Neumann's leadership became too erratic. He burned through money, he treated WeWork like a personal playground. Investors hesitated to act, they waited too long, and by the time they finally pushed him out, WeWork had collapsed from $47 billion to $450 million. Tesla's investors are watching closely. If the stock continues to slide, they might push for a leadership shakeup before things spiral too far. Right now, Tesla's market cap is propped up by Elon Musk's vision for the future, not just its car business, and that vision is starting to show some cracks. Tesla's $845 billion market capitalization is built on the promise of its AI and self-driving technology, not just its vehicle sales. Investors aren't valuing Tesla as a car company, they are betting on its future as an automation powerhouse. Now, that narrative is at risk. For the first time since 2011, Tesla's global vehicle deliveries are declining, down 1.1% year over year. Operating margins have shrunk from 16% in 2022 to just 8.3% by Q4 2024 as Tesla slashes prices to stay competitive. The average number of days to sell one car has jumped to 48, up from 28 last year, signaling softening demand. If Musk stays, the chaos could continue. in which case the stock will remain volatile and Tesla risks bleeding investors and losing customers and watching its competitors pull ahead. This is why Tesla's institutional investors are nervous. BlackRock and Vanguard, two of Tesla's largest shareholders, have already pushed for an independent chairman. They argue that Musk's political entanglements and divided attention are now an active threat to Tesla's brand and valuation. If Musk decides to step back, or if the board forces a leadership change, Tesla might take a short-term hit, but history shows that in the long run, companies recover when they move past a problematic founder. And when companies reach this point, they do always have options. There are likely three paths forward. 1. Tesla moves Musk into a chief architect role, allowing him to focus on AI and innovation while appointing a new CEO to handle operations. This is the Google model, similar to how Larry Page and Sergey Brin stepped back and let Sundar Pichai run Google's core business under Alphabet. 2. Tesla restructures its governance, giving Musk super voting shares like Mark Zuckerberg at Meta. This would protect him from investor revolts, but it could also increase Tesla's debt risk, as rating agencies might see it as a governance downgrade. 3. Nothing changes. Musk stays in full control, Tesla rides the volatility, and investors gamble that his long-term vision outweighs the short-term chaos, and maybe everything works out fine. But this third option carries serious risks. History is clear. When a founder becomes a risk, the board steps in. Apple did it in 1985. Steve Jobs was fired from his own company. At first, Apple struggled, but when he returned in 1997, he was stronger, more focused, and better at running a company. Google did it. Larry Page and Sergey Brin stepped back, let Sundar Pichai run the company, and Google kept growing without them. Even General Electric did it with Edison. No founder is bigger than the company they built. Not Edison, not Jobs, not Kalanick, not Newman. If Tesla's board and its shareholders decide Musk has become a liability, he won't be the exception.